Hello, and welcome to Taxes in 10, where we take a tax topic and break it down in about 10 minutes. My name is Mark Barnes, and I am the managing partner of Copper Canyon Tax and Accounting Services in Tucson, Arizona. We are a boutique firm that specializes in small business accounting and taxes. This episode is on health savings accounts. What is an HSA? A health savings account is a tax-advantaged medical savings account. It is available to U.S. taxpayers who are enrolled in a high-deductible health plan. The funds contributed to an account are not subject to federal income tax at the time of deposit. This is true whether you are an employee making a deduction and taking an above-the-line deduction on your tax return, or your employer is making a contribution on your behalf and it is a tax-free fringe benefit. Code Section 223 states, a deduction is allowed in the case of an individual who is an eligible individual. A deduction shall be allowed for the taxable year equal to the amount paid in cash during such taxable year by or on behalf of the individual to a health savings account. What is an eligible individual? The term eligible individual means any individual covered under a high-deductible health plan as of the first day of the month, and the individual, while covered under a high-deductible health plan, is not covered under any other health plan, which is not a high-deductible health plan and which provides coverage for any benefit which is covered under the high-deductible health plan. Certain coverages are disregarded. Coverage, whether through insurance or otherwise, for accidents, disability, dental care, vision care, long-term care, or in the case of plan years beginning on or before December 31st, 2021, telehealth and other remote care. Special rule for individuals eligible for certain veterans benefits. An individual shall not fail to be treated as an eligible individual for any period merely because the individual receives hospital care or medical services under any law administered by the Secretary of Veterans Affairs for a service-connected disability. The advantages of having a high-deductible health plan and an HSA include an above-the-line deduction for the money you put into your account versus having to itemize and exceed the 7.5% threshold for medical expenses. The ability to roll over funds from an IRA to your HSA account tax-free. This is a once-in-a-lifetime opportunity to fund your account on the front end or to fund your account to assist in covering current medical bills. More on this in a few minutes. Taking a deduction for your HSA contributions may lower your income enough to qualify for other tax credits or deductions. HSA funds can be used to reimburse taxpayers for Medicare premiums, but not premiums for Medicare supplemental insurance. And they can be used to pay for long-term care costs and insurance. Most HSA banks offer some level of investment product. My account is at Health Equity, and I have lots of options. I keep enough cash on hand to cover reoccurring medical care, and anything above that amount gets invested. I just looked at my invested portion, and it's up 13.08% year-to-date. Disadvantages of having a high-deductible health plan and a health savings account. Medical costs are unpredictable. Unlike the grocery store, it is hard to get an actual cost for medical services. What I have found is that it costs a lot less to simply pay cash. In 2019, I had to go in and get my neck and back x-rayed. The girl at the counter wasn't sure what to do when I said I just wanted to pay cash for it. She charged me $98.40 for 6 x-rays. A month later, they refunded me $48. My out-of-pocket cost was $50.40. You have to actually save money if you expect to go to the doctor. And you can't pay medical bills that occurred prior to you having an HSA account open. My number one rule is this: open your HSA and put $5 in it. Now your account is open and funded. You can always add more money in the future, but now all qualifying medical expenses can be run through it. Here's some important things to consider. Hopefully, we're all familiar with Internal Revenue Code Section 72T and the ability to avoid an early withdrawal penalty on qualified distributions to pay for medical expenses. This is on Form 5329. Please remember that your medical expenses must exceed 7.5% of your adjusted gross income in order to avoid the 10% early withdrawal penalty. Generally, you are better off rolling money from an IRA to your HSA to pay medical bills compared to taking a distribution from a 401k to pay the costs. There's two main reasons. One, your income will increase by the amount of your distribution. This could affect more than just your income tax. It could affect tax credits and your ability to deduct certain items like student loan interest or real estate losses. And two, it only applies to medical expenses that exceed 7.5% of your adjusted gross income. Let's take a look at a scenario. Let's say your AGI is $100,000. You have an HSA that has previously been funded but doesn't have enough to cover a $7,000 medical bill. You have a family plan, and you've never completed an IRA to HSA rollover. You are better off rolling $7,000 from an IRA to your HSA to pay the medical bill compared to taking a distribution from a qualified plan. In this scenario, your $7,000 medical expense does not exceed 7.5% of your adjusted gross income. So you are unable to exclude any of the amount from the 10% early withdrawal penalty. Most Americans become eligible for Medicare at age 65. Once you start Medicare, you now have other non-qualifying coverage and are no longer eligible to make HSA contributions. Participation in any type of Medicare, Part A, Part B, Part C, Medicare Advantage plans, Part D, supplemental insurance, and Medigap, makes you ineligible to contribute to an HSA. However, you can continue to use your HSA for qualified medical expenses and for other expenses for as long as you have funds in your HSA account. If you start Medicare mid-year, you have to remember that you are only eligible to contribute 1/12 of your annual limit per month of eligibility. Let's take a look at another scenario. Sally turns 65 on July 21st and enrolls in Medicare. She is no longer eligible to contribute to her HSA as of July 1st. Her maximum contribution for that year would be 6/12. She was still eligible for the first 6 months of the year. Multiply that by the applicable federal limit, and remember to include the catch-up contribution amount. Sally's contribution limit is $2,300 in the 2021 tax year. Sally has until April 15th, 2022 to fund her HSA account. There are two options for health savings accounts: single or family. Family is 2 or more people. Could be a married couple, could be a single parent and their child. There is a $1,000 catch-up contribution available starting in the year you turn 55. And you can take ordinary distributions free from penalty once you reach age 65. Before you rush out and get a high-deductible health plan and a health savings account, consider your medical needs and your ability to save money. If you find yourself at the doctor's office on a regular basis, or you don't have the means to save thousands of dollars each year, an HSA might not be the right type of account for you. But if you do have extra money, would like an additional tax write-off, and don't visit the doctor very often, this is a great opportunity to save, reduce the taxes you pay, and have money available in the future for long-term care premiums, to reimburse for Medicare costs, or to take as a regular distribution after age 65. Make sure to hit the subscribe button to keep up to date on all of our Taxes in 10 video series, and give us a like on Facebook at facebook.com/potentialcpe and on Instagram at potentialcpe. If you are interested in earning continuing education on this topic, please visit potentialcpe.com for a list of all the courses we provide. Our 1, 2, and 4-hour on-demand webinars will focus approximately 75% of each hour educating theory and regulation, and 25% of each hour on procedure, with real-life examples to walk you through completing the necessary forms to increase your potential.